In its latest global economic prospects released in June, the World Bank has raised its global growth forecast for 2021 from 4.1% to 5.6%, the strongest post-recession pace in 80 years. Some economies are forecast to do better than the average, including China and the US. But the recovery is uneven across the world. Well, given these uncertainties, how should investors position their portfolios? Well, to answer that question, I'm joined by a very special panel of guests today. They are, to my left, Mr. Vasu Menon, Executive Director of Investment Strategy at OCBC Bank, Ms. Angela Mancini, she's Partner at Control Risks, and Mr. James Cho, he's Chief Investment Officer, Southeast Asia at HSBC Singapore. Welcome to all of you. It's good to see you here today. So this pandemic has changed our lives in a very special way. We have got a new normal. It's being described as this once-in-a-lifetime event, principally because of the manner in which our behaviors have changed. So to begin with, I'd like to invite all of you to give me the top 2 trends that you're going to keep your eye on post-pandemic. James, let's begin with you.
I think to start off, what's very important is that at least for this year, the growth and inflation dynamics is very crucial because when we look at growth, it has been very strong because of the reopening. But of course, with the pandemic, it's still not over. There could be twists and turns and bumps along the way. And therefore, I think that differentiation, that staggered recovery, it's going to be something that investors would have to watch out for because different countries will recover at different pace. But at the same time, I think inflation dynamics is something that's a bit worrying because the reopening pressures are very strong. The pent-up demand is very, very robust. But at the same time, you get some supply bottlenecks that's creating higher prices. And as a result, there is this sort of a mismatch in terms of demand and supply.
Angela.
The first one I'd say for sure, digitization. We knew it, it's not a surprise, but the rapid rise of digitization across all sorts of sectors that you wouldn't expect. So of course we see it with e-commerce, we see it with digital payments, we see it with telemedicine. So what's interesting is it's being consumer driven. Those are platforms that consumers want to engage with, but there's the whole back end infrastructure behind it, right? So data centers and how businesses are putting things into the cloud. And so from a risk perspective, you obviously have cybersecurity risks, but there's also regulatory risks, right? Because every country is looking at data now as a national security issue potentially. And so how do companies navigate those different digital sovereignty risks around these different markets with these platforms? And then the second one for us has to be ESG, environmental, social, governance risks. And the thing I would say about that is that was an issue before the pandemic. Similar to digitization, it hasn't come about as a result of the pandemic, but the acceleration has been significant. And so what we see is with the board directors with whom we work, that is the top risk for them, I think, because of this focus on existential risks that we hadn't been thinking enough about.
Vasu, your 2 top trends?
Well, I think if you look at what has happened in the first half of this year, tech stocks have taken a backseat. But as Angela said, you are seeing the digital transformation of the global economy. It's unstoppable, it's accelerating. So that breather, I think, will now give way to greater interest in tech stocks. I think so you could see technology stocks coming back to the forefront to some extent. Tech stocks have underperformed value stocks. The second trend is, I think, as the economies reopen, clearly inflation is in the forefront, it's in the headlines. And so investors will be looking for ways to benefit from the reopening, plus looking out for, in some ways, inflation hedges. So I think the value stocks, although they may take a breather, they will still continue to offer pretty good returns. They will benefit from the reopening of the economies. And with inflation in the forefront, investors will be looking out for inflation plays. And so sectors like financial services, sectors like energy, commodities could all benefit. So it'll be a combination of growth and value.
Recovery has been uneven across the board. Some countries are doing better than others, and some have even revised their GDP projections upwards. China being an example, the United States, Singapore even. So is this going to influence the manner in which people park their money?
Well, clearly the upward revision in numbers means that, there are good reasons for investors to be optimistic about the future. But bear in mind that some of that optimism has already been priced in because stock markets have done exceptionally well. Stock markets are a discounting mechanism, so some of that optimism has been discounted. But nevertheless, having said that, there's still more upside. because valuations are not excessive at this juncture. Still lots of liquidity on the sidelines. Policy is going to stay accommodative. But the difference is that, I think going forward, given the fact that some of the optimism has been priced in, the gains going forward may not be as strong as they were in the last 15 months. So that's something investors have to adjust to in terms of expectations.
Angela, we've seen those supply chains be disrupted. We've seen people sort them out as well and try and grapple with how to chip away at operating costs as they did that during this pandemic year. How far have we seen that capacity to sort of adapt, to persist in all of this in terms of a company's strategy, as it were?
It's funny because in the past, success was if you could have one global supplier that was cheap, that was great. That was success. Now that is absolutely a recipe for failure. And not only will CEOs and management not tolerate that, but neither will your customers. So what we've seen is a lot of supply chain, relocation out into the regions, but driven also by customers. So especially Fortune 50 clients, or if your clients are governments, they will not tolerate a lack of resiliency in supply chain. So we're seeing more factories, more warehousing, more inventory, more suppliers. That's expensive. It's adding cost into the supply chain, so someone's got to pay for that. So that's going to come out in some form, either reduced profits or higher prices for customers. But the other thing I'd say on the back of that is a really interesting shift away from a lot of the management being kept at global headquarters and devolving that authority out to regional headquarters. And we're seeing that a lot here in Asia.